Hi everybody, this is Alan Ellman, the Blue Collar Investor, welcoming you to the Beginner's Corner information series for selling cash secured puts. This is lesson 2 on options basics, or the principles and definitions you need to know to create the foundation for selling put options. Now we're going to start off first with a few definitions that you need to know in order for you to be able to utilize this great strategy. So let's first start off with what is selling cash secured puts. Well, the first step in the process is to select an underlying security, be it a stock or an exchange traded fund ETF. Once we've selected the underlying security, we then sell the put option. What we're doing here is we're selling some unknown person, because everything is done online, the right but not the obligation to sell us their shares at a specific price known as the strike price by a specific date known as the expiration date. Now, most options expire on the third Friday of the month at 4 p.m. Eastern Time. Now, for undertaking this option obligation, we are paid cash, which goes directly into our brokerage account. This cash is known as the option premium, and the amount is dictated by the market. So what we do is we place the cash into the brokerage account to cover the possible amount that we need if that future trade is actually executed. In other words, if the option buyer executes the trade and decides to sell their shares to us, that cash is then in the account to purchase the stock or ETF. There are two types of options. First is call options, which we will not be dealing with in this video series, but actually we do have a full Beginner's Corner information series on covered call writing also on our website, www.thebluecollarinvestor.com. So check that out as well. So call option gives the right to the holder to buy 100 shares of stock at the strike price by the expiration date. The put option is the opposite. It gives the holder the right to sell 100 shares per contract at the strike price by the expiration date. So what we're doing is we're selling these put options after securing the potential trade by placing cash into our brokerage account. Now, the next three definitions relate to the strike price as it relates to the current market value of the underlying security. At the money is where the strike price is the same as the current market value of the stock. So let's assume for a moment that a stock is trading at $30 and we sell the $30 put option. That $30 strike price is said to be at the money. The next definition is out of the money, and that's where the strike price is actually lower than the current market value of the stock. As an example, if a stock is trading at $32 and we sell the $30 put option, that $30 strike price is said to be out of the money. And the third in this series of definitions is the in the money strike, and that's where the strike price is higher than the current market value of the stock. So if a stock is trading at $28 and we sell the $30 put option, that $30 strike price is said to be in the money. Now I'm going to discuss the option premium, or the cash generated from the sale of the put option as it relates to the strike price. Now, an option premium consists of intrinsic value plus time value, but only in the money strikes have an intrinsic value component to the option premium. Let me give you an example to help this come alive. If a stock is trading at $28 and we sell the in the money $30 put option for $3, of that $3, $2 is intrinsic value. That's the amount that the put option is in the money, from 28 to 30 by $2. Now, the time value component of the premium is everything above the $2 intrinsic value, in this case, $1 more to the $3 premium. So time value is the option premium above any intrinsic value. In this case, it's $1. Now again, only in the money strikes have an intrinsic value component to the option premium. At the money and out of the money strikes consist of all time value. And in the money strikes, of course, consist of time value plus intrinsic value. And that pretty much takes care of the definitions. Next, I want to talk about the options chain. Now, this is a list that quotes option prices for a particular security. Well, all online brokerages have these, but there are also some free sites. One such free site is finance.yahoo.com. So let's have a look and see how we can access this information that will tell us how much cash we could generate by selling these puts. If you go to the site finance.yahoo.com, just put in the ticker symbol of the underlying security. In this case, it's Nuance Communications. And with the ticker symbol is NUAN, where you see the red arrow. Then you click Get Quotes, where you see the blue arrow, and that will lead you to the next page. And just look for a link to the options chain. And that's highlighted by the red arrow on the left side of the screenshot. Now here's a typical options chain from another site. This is not the Yahoo site. And I just want to break this down for you. If you take a look at the top left portion of the screen, I highlighted in pink for you the current market value of CRZO, which at the time was trading at 44.61. Now on the left side of the screen are the call options, and on the right side is the price list for the put options. And since we're focusing in on selling puts, we're going to focus in on the right half of the screen. So I've highlighted a row in yellow, and that's the 42.50 out of the money put, because it's lower than the current market value, making it out of the money. Now in the middle area of that yellow row, you see a bid and an ask column. The bid column is the price that we will get from selling the puts. The ask column is the amount we'd have to pay if we purchase the put. So in this case, we would generate $1.30 or $130 for the 100 shares that make up one options contract. So once again, in this particular hypothetical here, we're selling the 42.50 out of the money put for $1.30. Now let's assume for a moment that the price of the stock remains above the 42.50 strike, in which case the option buyer will not exercise. So in that case, the option goes unexercised, and our 1 month return is the $130 generated from the sale of the put, divided by our cost basis, which is 42.50, the amount that we have to have in the account in case the option is exercised, less the put premium. So we actually have to put in 41.20. The broker will allow us to apply the put premium to the total 42.50. So the total then 1 month return, if unexercised, is 3.2%. Very nice return. Now what happens if the put option is in fact exercised when the price of the stock dips below the strike price of 42.50? Well, we are obligated then to buy the stock at 42.50. But our cost basis is actually the 42.50 less the premium we receive from the sale of the put, which brings it down to 41.20. Now, if you recall, the original price of the stock when we entered the put trade was 44.61. So the discount at the time we purchased the stock as a result of the put being exercised is then 7.6% discount. Okay, so let's summarize then. Options are contracts that give the holder the right to buy in the case of a call option or sell in the case of a put option. Strike prices can be at the money, in the money, or out of the money, depending on the strike price in relation to the current market value of the stock. And option premiums consist of intrinsic value plus time value, but the intrinsic value applies only to in-the-money strikes. And an options chain will provide quotes for all the different option prices for a particular underlying security, be it a stock or an exchange-traded fund. And that pretty much takes care of the option basics, as it relates to this great strategy of selling cash secured puts. Now, in the next lesson, lesson 3, we're going to begin to address how to select the underlying security. Now, there are 3 screens that we put our underlying securities through to determine whether or not they would be great put selling candidates. Fundamental analysis, technical analysis, and certain common sense screens. In lesson 3, we're going to focus in on fundamental and technical analysis. So thanks for listening to lesson 2. I hope you enjoyed it. Hope you benefit from it. And as always, this is Alan Ellman, the Blue Collar Investor. See you at lesson 3. Take care, everybody.